Good afternoon, everyone. Thank you for joining us today for the first of our ECL webinar series, From Incurred Loss to ECL, Understanding the Framework and Assessing Your Data Gaps Now. We're glad to have you with us, whether you're a credit risk professional, a finance leader, or someone working through your ECL readiness program right now. You're in the right place. With that, let me tell you a little bit about who we are. Ultradomus operates across 38 offices in 22 countries, spanning Europe, Asia Pacific, and the Americas, from London and Luxembourg to Sydney, Hong Kong, and Singapore, and across the United States. We serve clients with a regional, on-the-ground approach backed by a truly global support framework. What that means in practice is that our teams understand local regulatory environments while drawing on a depth of international experience that very few firms can offer. We are not applying a generic template to your situation. We bring insight from markets that have already been through what India is navigating right now. And that brings me to why this webinar series matters and why we are uniquely positioned to lead it. Our global experience credentials in credit loss are extensive. We have spent over 15 years implementing IFRS 9 and ECL across financial institutions around the world. Our teams have led loss forecasting, stress testing, and capital planning programs at the highest levels, and they include bankers, credit risk leaders, and model developers with expertise across all major loan types. We know what good looks like in ECL implementation, and we know what poor data governance and model shortcuts look like too, because we've seen both up close. That experience across dozens of implementations is exactly what we will be drawing on throughout this series. Closer to home, our India team brings over 11 years of experience supporting banks with credit risk and model development. They have a deep understanding of the local banking landscape, the regulatory environment, and the practical realities of implementation. Combined with our global experience, this positions Ultradomus to offer something very specific, real-world, field-tested guidance tailored to Indian banks making the transition to ECL under RBI's framework. Our team leading this series includes specialists across credit risk, model development, loss forecasting, and analytics. And you're going to hear from several of them today and over the coming weeks. Speaking of which, let me introduce the person who will be leading today's session. Harvey Plant. Harvey Plant is the director here at Ultradomus and the product manager for our credit risk and analytics team. Harvey, we'll turn it over to you.
Well, thank you, Rob, and welcome. Hello, everyone, and welcome to our first ECL webinar session. Just a quick overview of the agenda. We're going to focus today's webinar session on data. We're going to talk about data sufficiency. We're going to talk about a data assessment, lessons learned from our prior implementations, as well as an ECL roadmap, and then we're going to have some conclusions and summary of today's sessions. But before we delve into the ECL framework and data, I do want to talk about something more fundamental to this transition. What does this change actually mean? What does it mean strategically, operationally, and organizationally? In our experience, the implementations of IFRS 9 and ECL, the ECL transition was not just a change in how you calculate a number. It was a transformation on how institutions needed to think about, manage, and communicate credit risk. It was a fundamental shift in how credit risk was understood, measured, and acted upon. So let's talk about some of the shifts and transformations you will see and what they will mean for you and for your organization over the next 12 months. The first shift is one that goes from a backward-looking ECL to a forward-looking ECL. Ask yourself this question. Under the old framework, were institutions really measuring risk they have or just the losses they had already seen? This is probably the most important question to start with because it gets to the heart of why this change was made. Under your current legacy framework, provisions were triggered only at the 90 days past due mark. What this means is that risk existed well before this trigger event occurred. The question is no longer has a loss happened, but the question is now, what is the probability weighted expectations of loss given everything we know today and what we expect tomorrow? A second shift is a new way of thinking about risk. This brings me to the heart of what I want to convey mostly today. The ECL framework introduces several characteristics that fundamentally changes the nature of your work, and each one carries real strategic and operational consequences and brings to the surface the most important question you need to answer. For example, is your institution currently equipped to assess changes in credit risk at every reporting date? And do you have the data, the governance, and the processes to do so consistently, period over period? Another question is, what macroeconomic variables are most correlated with the credit risk in your specific portfolios? And who in your organizations owns that view? ECL is a continuous quantitative and qualitative assessment that requires data, governance, and a disciplined process at every closing period. These questions are the operational realities your institutions will face. Another one is the role of the ECL team. I think this is one of the most underrated transformation that you will experience under the new requirements. The ECL team's role will expand dramatically. The process you performed under the incurred loss methodology will move away from a function that operated in the background. It will now move toward a process that is a critical component of both financial reporting, and risk management. Ask yourself this question. Do you know who your new stakeholders in the ECL process will be? And are you already engaging and aligning with those stakeholders? Those stakeholders may be senior management and board of directors, finance and accounting leaders, the treasury team, risk management leaders, as well as business leaders. Understanding who your stakeholders are, will become a very important part of this transition. Another transformation is the significant introduction of economic forecast and forward-looking scenarios in the provisioning process. For example, you will need to answer this question. What does a 10% increase in unemployment or a 100 basis point rise in interest rates mean for your ECL? Can you answer that question today? This will be a question you will need to answer not only at quarter end, but at any point in time. There will be moments when economic news breaks, when market conditions shift, and when senior leadership turns to the ECL function and asks, what is our exposure? What does this mean for our provision? We see this consistently in institutions that have already gone through this transition. Management will want to understand the ECL impact of different economic scenarios, a baseline, an optimistic outlook, and even a severe downside. This is part of the ECL transition that takes what you do beyond performing a regulatory requirement. It makes what you do a strategic tool. I want to leave you with this final thought. Your ECL transition will become a driver of strategic decision-making. There is no doubt about that. The outputs of a well-built ECL process, such as the probability of default, the loss given default, the exposure at default, are not just provisioning inputs. They are the building blocks of better business decisions. Consider this. Are you pricing your loans to reflect the true expected credit loss embedded in each exposure? Maybe, maybe not. How will ECL outputs feed into your capital assessment process and your strategic planning process? ECL outputs that inform pricing and capital allocation decisions create a direct link between the provisioning process and the institution's financial performance. This is part of the strategic value you and your institution can create. So today we begin to explore how to make the ECL process a transformation opportunity for your institution. And so with that, I would like to introduce Rob Ashbrook, who will moderate the discussion on data requirements. And thank you, and we hope you find today's sessions helpful. Rob?
Harvey, thank you very much. Definitely, thank you. Very important what Harvey said. This is not a standalone calculation. This is going to be a strategic tool, a strategic model for banks to look into their portfolio to see how it's going to perform under a variety of different economic and portfolio inputs, if you will. As you mentioned, we've got more than 10 years of experience working with banks across the United States, CECL, IFRS 9. We've seen banks go through this process. And what we've learned is, it comes down to data. Everything starts with clean data. And that's going to be the focus of the webinar today. If you don't have clean data, you're not going to have a clean model. You're not going to have clean results. But one of the things that we've learned is, banks start thinking about the model before they start thinking about the data. And we've learned that that's backwards. A lot of folks went out to try and develop a model or find a model provider before they really understood how much data they had, what their quality was. So we've got a few experts here on the line, colleagues of mine here from Altadomus. We've got Srividya, Abuday, Brian, and Rahul are going to kind of be our experts here for this conversation over the next 30, 40 minutes, if you will. For the folks here, for our expert team, tell me why we need to be thinking about data first before we start thinking about the model development aspect. Why is that data going to be important?
Well,
Sure.
Using something like credit ratings as an example here, there's been white paper studies that have shown between credit state movements make up about 80% of the explanation for default risk. And so if you can get your credit ratings right and see those types of transitions accurately, that's going to go much further than looking forward down the line saying, oh, we have to produce a regression model that predicts correctly, when that's going to have a much smaller impact on the actual probability of default than something like just getting your credit ratings right. Raul, you?
No, I agree. I agree with that, Brian. And just to add to that, I think in general, from a practitioner perspective, selecting a model, prior to looking at your data, it just becomes highly inefficient, right? So you think about the ECL, there's multiple components involved, right, which we'll be covering in more detail in the next webinar. But given there's multiple components, the ideal target state is that those multiple components leverage, a single source of truth data set, right? Whether it's prepayments, whether it's probability of default, loss given default, exposure at default. Ideally, all of those components leverage one single source of truth, one data set. And by looking at data first, prior to modeling each of those components, you're just going to have a more efficient onboarding implementation of the ECL. And 9 times out of 10, there's always going to be data quality issues, right? And by putting data first, we can address that up front, before entering the modeling stage. Because ultimately finding a data quality issue at the tail end of it, right, it's can create a lot of unnecessary rework during the modeling phase. And so it's just important to address those data quality kind of data nuances up front. And there's ways to do that, right? You could do reconciliation by product line, right? Loan counts, balances. You can run a series of data diagnostics. And just from a practitioner perspective, this is certainly an iterative process, right? There's no way around that, but I think putting that work up front, it certainly pays off once you enter that modeling stage.
No, very well said. I mean, we're 9 months out, and we're going to talk about what this process is going to look like. But it starts with data. If we're thinking about the different data fields, think about a typical core system. There might be 50 different data fields that may be tied to a particular loan or a borrower. What are the typical fields that might be required for a CECL model that they can start looking at today from a validation standpoint?
I mean, generally speaking, and the team can provide some specifics, but your data set can be categorized as to data that's required, that you need, right? The fundamental set of data, balances, rates, maturities, all the terms, things of that nature. risk ratings, right? Days past due. Then you have the other set of requirements, of data requirements that can provide insights in terms of reporting. So if you think about what type of reporting you may need, right? And if you don't know what that reporting is, then you may end up not categorizing or classifying your data needs very properly, right? So you need to know data that's at a minimum what's required, data that you can use for reporting as well. And then the other set, I think, is a broader category, which I think helps users be able to shift and evolve in the future. So if you have hard-coded data around which pools or segments the loans are going to be classified under, that's great. But if you provide that rather than providing the values of the fields that will determine what those categories are, if you do that, you'll be able to change and evolve your segmentation. So not only what data is required, and what data you need for reporting, but there are also some data that can be used as inputs for changes and modifications to your framework. And I think that's probably one of the areas that clients and institutions tend to think that, hey, if I provide you a hard-coded value, that's easier. Quite honestly, no, that's not. And sometimes institutions do that because they don't have the right framework or the process to handle the granular level of data you need so that you can scale and evolve down the road.
Great points. Is there a minimum number of history banks need to think about? How much history are we talking about? Is this kind of 2-3 years, or what's an optimum number of data history in terms of years that a bank should really start thinking about gathering today?
Optimally, I mean, is as much as they can provide, honestly. Different banks have a different history. Theoretically, if we could go 10 to 15 years back, the more history you have, the better predictions you're going to be able to make. But the bottom line is just trying to get the data you have as clean as possible. And so if that's 5 years, if it's clean, that's better than 10 years of bad data.
Brian and I, we attended years ago prior to the implementation of CECL, which is kind of related to IFRS 9, just a couple of different aspects of it. But there was pre-CECL, there was a lot of discussion around data sufficiency and how much history, right? And one of the speakers in one of these conferences, I believe it was a regulator, actually said, having 10 years of history, but not sure of the quality of the data, versus having 3 or 4 years of history and having good quality, right? Those 3 or 4 years are more valuable to the model and calculating your ECL because of the quality. And that really touches on what Brian said. We want as much data as you can provide, you should use, but not at the sacrifice of quality. So if you only have good quality over a period of 3 to 4 years, that's better than having 8 to 10 years of data that doesn't have high quality.
Yeah, I would say higher and clean data will be acquired higher accuracy. So, yep.
Absolutely.
And I'm assuming you want to make sure you document that. Document how many years you have. Document anything around that data history as well. And we're going to be talking about that a lot during both this webinar and future webinars. But everything that you're going to do around data validation, anything around your assessments, you want to make sure you document along the way. That's going to be critical when we get to sort of the audit and the examination process. They want to make sure they know what you're thinking and what your thought process was. All right, so we talked a lot about data. We talked about data history, but as Harvey talked about, we've got data gaps. Banks have always had data gaps. We've learned. Harvey said 99% of the time, all banks are going to have some sort of a data gap, and we need to make sure the banks understand these data gaps, the cost of their data gaps. a few things around the data gaps. We've got two different components that we're going to talk about here. Both without that sufficient data, banks are going to rely on these regulatory backstops. And that's something that's a little bit more unique to this ECL model, if you will, is this regulatory backstop or floor. I'd love to get your thoughts about how conservative you think these backstops are. Do banks really run the risk of these being sort of artificial, if you will? If we've got issues with data, for instance, are banks going to rely on these data floors to kind of mitigate any impact of these data gaps? And kind of love to kind of get your thoughts on that as well too. Is also kind of some of the qualitative aspects of a calculation, but for Brian or Rahul or Abudeh or Suridia, what are your thoughts on some of these regulatory backstops, if you will? Again, that's new for us here in the ACL world.
Sure, I can kick it off here. So I think oftentimes in practice, if we see data gaps, right, they're typically attributable to specific product lines, right, as opposed to the whole portfolio. This could be the case, for example, if there's limited loss or default history, or perhaps there is a new product line, right, that the institution launched, and the institution doesn't have much history on that new product line, right? So there's a few avenues that we've seen institutions, how they navigate, that type of occurrence. One is institutions will look at peer or consortium data to produce kind of a suitable proxy reserve estimate based on the loss rate. So that's kind of one approach we've seen clients use. Another avenue is, clients may look at their existing portfolio to see if there are any shared risk characteristics on existing pools, right? To use those as a proxy as well. The third point is, I'd say, materiality, right? Materiality is very important. So if it's an immaterial pool, typically they'll establish some form of a floor, right? Some form of a regulatory backstop. And then finally, the fourth avenue they will use, and I'll say typically this is more of I wouldn't say last resort, but really usually the final option is just some use of qualitative factors, right? So generally speaking, the purpose of the qualitative factors is to account for risk that cannot be quantified, right, using the data that is available. And so that's why I say it's typically kind of the last option if a suitable proxy can't be established. So those are just some of my thoughts, Rob, on
and that's a great point there.
Backstops.
Qualitative factors. We've been through this with CECL a lot. Banks become over reliant on qualitative factors. Really, like you said, to account for model risk that you can't really quantify, and that gets down to the data. We've always tried to focus on client data. And it makes a model it makes it less subjective. It makes it a little easier to defend on this. And I think qualitative factors are going to be new for Indian banks. We're going from just a 1-year incurred model to a life of loan estimate, especially for stage 2. What are some things that banks need to think about with qualitative factors?
One thing I would say with qualitative factors too is, it's easy to sort of fall back on that because it is easier than coming up with a quantitative number because you don't have to have the data to support it. You don't have to put the work in. But there is going to be an expectation if you rely on a qualitative factor that it has to be more conservative. And that's going to produce a higher allowance. And so it is worth putting in the work to be able to support those quantitative numbers first. There's always going to be certain qualitative factors that come into play because there's certain things that just can't be modeled quantitatively, unsystemic risk, that sort of thing. But if you can, it's always better to try to quantify something, even though it may be easier and quicker to fall back on the qualitative.
Even if you quantify the qualitative, you want to make sure
Right.
your qualitative factors have sort of, reasonableness that they're tied to a specific factor. if GDP does this, then this qualitative factor does that, or if delinquency does this, a qualitative factor does that.
And that's a
Yeah.
very good point, because with there's the thought, oh, we just throw a qualitative factor in there, but the regulators aren't just going to let you off. Like, they're still going to ask, how did you quantify that qualitative? So,
Right. And one of the things they're going to do too, right, Brian, is they're going to make sure that you don't double count, right? That you don't have something that you're accounting for in your qualitative marks that you have in your quantitative model, right? So that documentation you're going to need for a lot of reasons. One is to prove that you're not accounting for it. So your qualitative should be everything that's not in your quantitative. Rob, I want to go back a little bit and touch on this whole concept of the floor. I know that the Reserve Bank of India's ECL requirements has instituted a regulatory floor backstop, right? And institutions under IFRS 9 and CECL don't have this regulatory backstop. But we have seen many institutions who actually use that. They'll set a floor themselves, right? Their own internal policy to set a floor. And they may do that for a number of reasons. It just may be a conservative approach. It may be to address data issues in terms of sufficiency, but nonetheless, they'll use a floor. What institutions must recognize is that if they use a floor, that doesn't mean that they need to stop doing the quantitative modeling, right? And so what we've seen institutions do who have a floor, they will continue to do the model, right? And they'll continue to run it and they'll get some output. But they won't rely on that output because, let's say, they just don't have sufficiency in data for one reason, right? Or the quality is not good and they need some time to recover that. So they'll still run it, and then the system will determine that, and then they will fall back or default to the floor. But at some point in time in the future, and this is that question to one of the responses that Raul provided about understanding your model needs today by looking at what your data is, because at some point in time in the future, you're going to have sufficiency of data. You're going to achieve that. You're going to achieve quality, you're going to achieve sufficiency, and you're going to need to know when that happens so that you no longer need to apply the floor. So the applying the floor is not a get out of, it's not an easy button that you could just apply the floor and be done. It's just a backstop that allows you to provide a minimum. But at some point in time, you need to rely on your data to see whether or not your actual good data achieves that floor or still falls below it or surpasses that. And so once you achieve good data and you address your issues, then you really have to do that period-to-period comparison of your floor and to your output to make a decision. Right. So it's very important to continue to the quantitative and the qualitative process for those segments of your portfolio that you're using a floor until at some point in time, it may not be necessary to use a floor.
I think that's an important important comment there, Harvey. I mean, the floor is a regulatory mechanism, but understanding what your model is telling you before you even look at the floor is going to be important to make sure your model is running really as you think it should. It's going to tell you, is my data working? Are my assumptions working? You need to understand how your model is really working before you even address the floors. I mean, you may find that your losses might actually be less, forecast losses might be less than a floor. That's still an important thing to understand. These floors are not changing. We've not seen a mechanism for these floors to adjust, but understanding how your model is working before you hit those floors is going to be really, really important. Now, we've talked about these data gaps. We've talked about how important they are to address. Again, we're 9 months out. We want to really, really kind of focus on addressing what we call these data gaps. And part of that is going to be a data assessment. This is something that banks can develop on their own, but we've got a very kind of a timeline or a few key things that banks need to consider as they're developing a data assessment. A data assessment is going to address any of these gaps and provide, the basis for a remediation platform. Love to kind of walk through this and get everybody's opinion on what really is a good data assessment platform, if you will.
Yeah, I can start maybe. Since we talked about the data gaps, data sufficiencies, I think it is a time for the assessment. So as part of it, I think the first step would be the mapping of the existing fields, the data dictionary we have with the RBI ECL requirements. So with that, I can share my screen with the application there where I can walk you through the data dictionary which are available. So what you see in my screen is a dashboard by default. So if I go to the data dictionary, so what you see here is the data dictionary, as Harvey has spoken about this, the mandatory fields we have and the required fields for the reporting alone. So this screen, what you see, talks about all the available data dictionary properties. So, and also just to add on a little, we have user defined as well. So just in case to fit in, it is all configurable to fit in what you have as a data dictionary properties. It can be defined here, which is all configurable in our hands. So with that, I think the next assessment would be and the completeness. So a question comes in, are we ready for the change? Yes. But are we ready? Are we ready to change at what cost? Maybe the data should talk about it. So I would say at what percentage we have the full and clean record. So we've spoken about this at the very initial stage. So I would say higher the data, higher the cleaner data, higher the accuracy, definitely. So I'll pause maybe to have any questions, or maybe Rahul and Brian, you can pitch on.
Yeah, I mean, I think I would just add one aspect to just the inventory of data, in the sense that, it's important to also identify which data attributes are going to be required over time, right? So going back to, the first period of data to current period, versus what data attributes are required only for the current period on, forward, right? So I think, Harvey mentioned, amortization terms, right? Things like maturity date, interest rate, not balance, but, rates, maturity, any data attribute related to the cash flow, the amortization schedule, that's an example of an attribute that would be required only for the current period, right? For the purposes of projecting your cash flows. But historically, there may be attributes like your balances, of course, loan ID, right? So when we look over time, it's like, you can have things like system conversions, right? Where the loan ID itself changes over time. So you need a mechanism to understand that, hey, that, these two different loan identifiers are actually the same loan. So I would say it's important to distinguish, identify which attributes span historically versus those that we just need just from a spot period, current period.
Yeah, Shravidya, I think understanding the mapping and the inventory is I agree with you. It's very key, and I have some other examples that I think may not appear to be an issue early on, but will become an issue as you move forward in the modeling process. For example, maturity date extensions, right? If you that should be tracked, because that can have an impact on how your model handles that and what does it mean, right? The other one is product codes, right? So, for example, you have construction, and then you have a loan that goes from the construction phase to permanent financing. You need to make sure you have the right codes and the right triggers for those codes, because you may need to or may want to bifurcate that history of that loan into two different segments, because guess what? They do have different risk characteristics. So they're different. So you may want to treat it different. And the other part is, and we've seen this happen quite often, there's data fields that are not captured at all. They don't exist. But the institutions think about, wait a minute, in the future, we may want to have this, we may need this, right? And so what happens is they start to collect that data, and then hopefully over time, they will have enough of that data that they can use to inform their models. So it's not just about data that exists, but it's also about data that can change, to capturing data that can change, capturing the right triggers or the right events that make those changes, and data fields that don't exist that you may want to capture today for tomorrow.
And that kind of gets into these critical and non-critical deficiencies, sort of as we're looking at item 3. Item 2, we're talking really about, hey, run your portfolio, see what you have, see where you may have issues, but then you're going to be able to start identifying these critical and non-critical deficiencies, data that you have that you might need to fix, or to Harvey's point, data that you may need down the road. What are some examples of critical deficiencies that, and even non-critical deficiencies that banks need to start identifying right now? There's some examples here around collateral values and days past due fields and stuff like that.
Right.
But
I would throw one out, and I'll let Brian and Raul speak to this because they had to deal with this quite a bit in helping various institutions with their modeling. And that is the risk ratings as it relates to their underwriting process. So at some point in time in their history, the underwriting changed, right? They implemented a new risk rating scale, for example, on the commercial loans. So you now have history with 2 different sets of underwriting criteria. So the question is, what do you do? Because what was rated a 2 before is not the same 2 today. And if you don't address it, it's going to inform the model in a way that you don't want it to inform, right? And so, Raul or Brian, I don't know. I know we've dealt with this many times, and I'm sure you have some thoughts and stories around it.
Yeah, so this kind of gets back to something Roland mentioned earlier, and you as well, Harvey, which is that it's important. That's a big reason why it's important to get the data right first and then choose the model, because we have dealt with somebody started to build out this model, and they had it all set up, and then at that point they realized there was a major shift in risk ratings about 5 years into their history, and then they had to go and sort of mess with the model a little bit to get it to work with that data. Whereas had they just started with the data and corrected that first, then chose the model would have been good.
Right.
And at the end, they ended up having to change the model anyway. And so they spent all this time adapting the model, and then realized at the end of the day they had to go back and just fix the data to start with.
Right. And Brian, and the way they found out was there was a lot of noise in the output of the model, right? The ECL numbers that they were coming out with, right, just didn't fit and align with their expectations. And when they did some research, they found out that the root cause is a shift in the risk ratings that's embedded in their history.
Yeah. And
Brian,
sorry, go ahead.
Go ahead. No, go ahead.
Oh, I was going to kind of shift topic, but so if you wanted to.
Yeah, I was just going to say, that client that you're talking about that had to mess with the data, if you will. There's some risk by doing that too. I mean, you've got to make sure you're documenting anything, because you're changing an assumption, or heck, even adding an assumption potentially to account for that change in risk rating that they didn't understand that they needed to mitigate.
Exactly. Yeah, and the thing I was going to say on top of this is, along prioritizing critical, non-critical. The thing I would add to that is looking at balance of loan too. Like, start with the top 20% of loans by balance, because that's going to make up 80% of your ACL. And so that's something we've seen consistently too, is start with high balance loans and then work your way down from there. Especially if you're in a time crunch, because that's going to be the best bang for your buck.
Right. And in terms of assessing your where you are in the data assessment, start with those top loans.
Yeah.
Right.
What parts of the bank would be involved in any sort of a data assessment or even a remediation plan? We'll get into that in a second, but what areas of the banks are typically involved with assessing the data? Folks in finance and credit may be developing the models, but they're going to be relying on other areas. Who would be those areas typically?
Well, you're going to get, one of the things you're going to find out, and it's going to become very impactful, is when you're running your models and you get data on a monthly or quarterly basis, and the data quality is not consistent, right? So, which means is that your loan operations and your process around loan operations is not consistent or don't have the right governance around it. Those issues that kind of existed in the background and really never surfaced, guess what? They will surface today. So you're going to find issues where you're going to have to go give feedback to your loan operations. So you're going to work together with your loan operations, because the impact to and the noise that quality issues create is going to be bigger, right? And so it's going to have greater exposure. So you're going to have feedback to that. Then you're going to be working with other areas like treasury, right? To when you talk about prepayment speeds or growth, right? So, and that's one of the things that I think was understated in the when you're transforming from a backward looking to a forward looking, the number of stakeholders, it just is dramatic. The expansion is dramatic because there are so many other functions and business functions and operations that you in the past may not have had to deal with, but will definitely have to deal with going forward.
Yeah, I think to your point, Harvey, there will be a lot more people involved in this. It starts with loan administration. Like you said, at the beginning of the day, you've got people entering data in manually in the process into the system, making sure you go back in time, making sure you understand that all of that data is validated at the very beginning, not at the very end.
Yeah.
Making sure you've got, IT departments that are involved as well too. You're going to have a lot of people involved in this calculation that maybe you didn't really understand would be. It's going to be way more than credit and finance. It's
Yeah.
IT, it's loan administration. And we're going to talk a lot more about that over the sessions, but you're going to have basically an ECL committee that's going to either be formal or informal that you're going to have involved in this process. Now, we've talked about these deficiencies. We've talked about data gaps. Why is a remediation plan important? Why is it important right now? We're 9 months out, but why is it important? Kind of walk me through what would be involved in a remediation plan.
Look, the remediation plan is going to take a different, we've seen several different approaches. One is perhaps having to go back to some archives and getting data, right, that may not exist in your current system. It may exist in some other system that you converted from. So the effort of going and retrieving that data can be part of a remediation. The other one, as the team talked about, which is if there was a shift in risk ratings, right? So having to normalize some of that data may require going back in time and changing some of that data. The other remediation is you will, without a doubt, will have to make certain assumptions, and Raul touched on this. You're going to have to make certain assumptions and decisions, and it has to be documented, as you say, Rob, of those things, because there's going to be data issues that you can't fix. They exist. They are what they are. You're going to have to document that story, explain why, and then you're going to have to document your decisions or your assumptions around that and document that. And how are you going to mitigate that? Are you going to mitigate that through a qualitative adjustment? Are you going to mitigate that through some type of other model input? And for how long will you need to continue that mitigation, right? So the remediation plan is going to take several different aspects to address several different things. And you need to have that plan. And you don't know. Some of it can be very quick if it's all about decisioning and assumptions. But if it's physically trying to get additional data from other systems, that could take time, right? And remember, you're not doing it once, right? Part of the remediation is, okay, here's the data, how we're going to get the data. Now we need to make sure we have a process going forward for that data. And what's the governance around the quality of that data? So remediation is not just fixing and dealing with the history, but it's also taking that knowledge and then turn around looking forward and saying, okay, how do we make sure, what governance framework do we need to have to ensure that doesn't happen going forward?
And that's going to tie in nicely with our next slide. we've seen this up close with our CECL and our IFRS 9 clients. We've learned which fields, which data components had the most issues here. We've found that obviously the greatest predictor of a successful program is not the sophistication of the model, but the quality of its data. So let's look into the next slide and look at the 5 different types of data where we found the most issues with banks. Not necessarily types of data, but just the sort of data concepts. So we've got limited loan level history, poor data governance, incomplete loan and collateral information. So that's going to be like gaps in data or missing data, if you will. Related to that is going to be missing historical default and loss data. Some banks may not have data available more than 2, 3, 4, if you will. But understanding what those gaps are, or if you just happen to have missing data, maybe you don't have 6 months of data, if you will, or maybe you made an acquisition. But having the ability to account for that missing data is going to be important. But also the inability to kind of connect macroeconomic variables to loan performance. Are we able to make a connection between GDP and certain levels of default, certain risk ratings, if you will? But for the team, which one of these kind of causes the most issues for banks if they don't get this right? Is there one that kind of jumps out to the team that they need to focus on first, or is it a couple of these, if you will, that they need to get straight first?
I would say some drive others, right? So poor data
Yeah.
governance is going to cause, things like incomplete information or missing data. Limited loan level history, that's difficult because you may just not have it. If you don't have it, you don't have it.
Yep.
But like we said, it's better to make sure the data you do have is clean than necessarily have a lot of history. And overall, I'd say the 4 of these, the 5th one, inability to connect, that's kind of the consequence, right? Is if the data's not good, it's going to cause high variance, and that can make it hard to, correlate this to actual economic movements.
On the loan level history, if you only have 2 or 3 years, for instance, can you still get a defensible model with that? I mean, I'm assuming 2 years of good data is going to be better than 4 years of bad data, but can you run a model on 2 years, 2, 3 years, if you will?
Yeah, you can run a model on 2 to 3 years. And that's one of those things where, once again, it's like the model should be the last part. Get that data right, and then we can run a model. There's certain statistical measures we can look at to say, is this, defensible model or not? And if it isn't, then we take another path. We use the backstop. We look at a mean, something like that.
Oh, perfect. Data governance is going to be critical. Harvey talked about it a few minutes ago. If you don't get your data right first, if you don't get it into the system correctly, you're always going to have a problem. So this is always going to be an ongoing sort of a thing to make sure you are always scrubbing your data here. And that's still an issue I think a lot of banks still struggle with today, but making sure that they understand where their gaps are, they're regularly testing and so on, making sure you've got a process there. If you have incomplete loan information or missing data, are there ways to account for that? They just going to have to make certain assumptions, make certain disclosures, if you will, or is there anything that they can do to address incomplete data, if you will?
Yeah, I mean, we've seen cases, right, in implementations where there may be some product codes or risk ratings that are missing historically, right? And there's ways to treat that. You can backfill, right? You can take a kind of a backfilling approach. If there is 1 period's worth of data that is missing for a population of loans, you can interpolate, right? So I would say that's maybe a less severe issue, Rob, in terms of incomplete loan and collateral information. That's very common, in fact.
Yeah.
And we've helped institutions account for that and treat that.
If you have, you talked about the codes, if you have missing collateral codes or something, can you make certain assumptions? I'm assuming you have to document anything that you're doing here to address this, correct?
Yes.
Yeah.
For collateral, collateral code, if it's altogether missing, that can be challenging, right? You'd have to make some assumptions and document that. In collateral code, that's another example of a field that may not be required, right? If we're using collateral code to do segmentation, right, to segment by collateral, then that's where it becomes more critical, or for reporting. But from a model perspective, it may not be required.
Perfect. Thank you. Are you going to comment? Sorry.
Yeah, we're going to go into the missing historical default and loss data. And one of the things I think I don't think we've mentioned it yet. We talked about loan data, but I think transaction data is important, charge-off data and recovery data. We've seen institutions where that data is captured somewhere else, where that data is not easily accessible. So part of this assessment and part of the challenges is looking at the data around charge-offs, right, and recoveries, right, because recoveries play a very important role in coming up with a good PD and LGD. Because if you don't have recoveries, right, then your model output would be biased, right? And so, again, these are the small things that collectively add up to have a significant impact. We know that charge-offs and recovery data was challenging for many clients. And so now your governance has to be around that as well, and making sure that that data reconciles to your loan systems, your loan servicing systems, reconciles to your GL.
No, great point there. Again, you've got data on different systems. You've got loan data, to your point, over here. You've got charge-off data over here. You've got a lot of disparate systems that all need to sort of talk to each other in the model, in a model environment, if you will. And that's kind of going to be a great segue to our next slide here. There's some very unique components to an ECL calculation that are going to rely very critically on data. So first off, we've got staging. We've got 3 stages in an ECL model. We've got stage 1, which is going to be a 1 year expected loss based on PD/LGD. We've got stage 2, which is going to be a lifetime expected loss. And then we've got stage 3, which are going to be your defaulted sort of defaulted loans. But within that, we talk about this PD/LGD concept, PD/LGD EAD, if you will. There's going to be some very, very unique data fields in here that are going to be important for this calculation. Now, our next webinar is we're going to go through the whole model, but we're focusing on data here. What are the key data fields for a particular for part of this calculation, for the PDs and for the LGDs and for the EADs? Can you kind of walk me through, for the folks on the call here, kind of walk me through why some of these are very, very important, why we're using them for, say, a PD or an LGD calculation, and then kind of tie it back to, sort of the data remediation and sort of data cleanliness, if you will.
Sure. So
which might have the most data gaps, honestly.
Yeah. Starting with PD, the biggest factor there is going to be the risk rating history. How accurate that is, we've already mentioned numerous times, looking for shifts. If there's been any change in how we risk rate, we want to take that into account. And then obviously delinquency and default indicator are going to be pretty big there too, because one, are we accurately flagging whether a loan goes into default, and how are we flagging that? Is it that was 90 days past due? What's our actual trigger for saying something is in default? And then delinquency, that's going to be a big one for things like consumer type loans, where that's going to be your major driver of the shifts over time and what the risk associated with a particular loan is. On the LGD side, Harvey just went over this, looking at your charge-offs and recoveries. And recoveries are big too, because, a lot of times we look at, okay, here were the charge-offs, but eventually we can get a recovery too. And I would say LGDs, more than PDs, can be different among different banks. This was something we did a study with a bank that was finding they were using an LGD that was kind of like a market agreed upon LGD. But when we started to look at their contracts, they had much stricter covenants built into their loans, and so the LGD was way too high for them. And so if you don't have history, though, how can you support that? And then the last one, EAD, is sometimes forgotten about because you think about what constitutes a loss. Is it in default, and what is the actual loss on that? But with the EAD component, what we're looking at is here, we're talking about a probability of default. So we're looking at these kind of stage 2 loans mostly where, you know, they're a little higher level risk, and we have to project out their entire history. What's the probability default's going to hit? So getting the link to that history, the time it's exposed to these default rates is really important. So looking at things like maturity dates, and in particular, one thing that's not listed here is, do we have a good way to predict prepayment rates? Do we have a good history to look back? And that's something we've seen. Prepayment rates can sometimes have a bigger impact on the actual allowance number than default rates historically, just because it can shorten that exposure a lot.
Yeah, it shortens that tail, if you will.
Yeah.
Definitely. Staging's going to be a little bit unique here. Again, this is more, it's closer tied to the IFRS model. But understanding how a loan moves from stage 1 to stage 2, and potentially from stage 2 to stage 3 is going to be important. This is obviously, they need to make sure their history is clean in terms of that delinquency history, but they also need to make sure going forward that they're tracking days past due correctly, any non-accrual indicators, but also being able to identify those loans that have certain unique aspects of their portfolio that are going to make them a stage 2 and potentially stage 3, because now we're looking at certain industries, potentially certain other borrower specific things are going to be brought into this calculation. Walk me through what we think about in terms of, as we go forward into sort of ECL, why some of these indicators are going to be important for staging. Again, this for some of the Indian banks, understanding how loans move from stages.
Well,
and can a loan move from stage 2 to stage 1 too? And thinking about things like that.
Those upgrades and downgrades have to be part of the characteristics and have to help define your portfolio risk framework. So yes, they're very important. But when you look at it going forward, remember, one of the things is this is an ongoing, continuous quantitative and qualitative assessment of your ECL and your provisioning. And so this is not just about, okay, I get all my data today and I run it. You're going to constantly bring in new data. So understanding, now you have a rich database and you've documented the process, you understand what all of the characteristics are. As you move forward, you're building that. And what can happen is behavior changes, whether it's economic news, whether it's market changes, and you want to be able to track and see those behaviors, right? And if you can't, because you don't have the right data, you're not capturing it, then you're not going to be able to properly inform your model, right? And make adjustments as necessary. So building on that and tracking all that is just going to continue to provide you with sufficiency of data. And it's also going to give you insights on subtle changes and the risk profile of your portfolio for you to proactively identify potential risks that are coming up down the road, as opposed to in the old incurred methodology, finding out after the fact. And so relying on your data to proactively see forward is going to be critical.
Oh, great point. Again, this is probably, honestly, for this webinar, this is probably one of the more important slides and topics of conversation here, is understanding why each of these fields is going to be important and why we're using it for certain specific things. PD, probability of default, and LGD, loss given default, as well as the exposure at default, are going to be the key building blocks of your ECL calculation. And all of these are going to be critical to doing that calculation, making sure it's accurate. There's still time to address all of these different data points that we've discussed. There's still time to address, identify your data gaps, start a data remediation strategy. What we have here is sort of a timeline to get you ready for your April 1st, 2027 date, your go live, if you will. Now, we're basically in Q3 right now. But for banks looking to, what should they be doing here in the next 90 days? Obviously, we've got our webinars coming up here. We've got our second webinar, which is going to be August 6th. And we've got our third in-person webinar in September. But for a bank that's looking to go live, what should they be doing here in the next 90 days?
They need to start putting a data plan together, right? They need to start looking at what they have, right? Don't think about, okay, what do we need? First, think about what do you have? What kind of data do you have? How much history do you have? Where is it located? How is it governed? Can I have access to it? Where does this data reside, right? And any future changes, right? Were there conversions? Were there account number changes? Were there underwriting policy changes? All those things that you need to start to discover. So you're in a discovery phase, exploratory phase of just figuring out what you have, what's there, what exists. And then, that will naturally lead you into your next steps.
If there's one thing you could tell one of our listeners today, what would be the first thing they should do tomorrow morning? Where should they start? What should be the first thing that they do tomorrow morning, if you will?
Where's the data they have today? What do they have today?
Just run it. See what we have.
Just what we have today. What do we have today? Okay. And then figure out, okay, how much of this we have historically, what's missing. Ask yourself the question of how reliable is it? What's the governance around it? Can we use this data? Also ask, who else uses this data? Is this data changed by other groups? Who has access to the data? Is this data shared with other groups? And if so, for what reason? What do they do? So you just want to get a landscape. You just really want to figure out what it is that you have today.
And then developing a plan to address what's missing. I'm sorry, Suradia, did you have a comment?
Yeah, the consistent data, maybe, to see how consistent it is. And maybe not system generated, maybe they input manually, which can trigger the human errors. So they can go back, look into the manually input fields, which are mandatory for our models. So.
Yeah, and to Harvey's point, just asking, where is the data? Like, a lot of banks have multiple core systems, and it can be, different by segment, and just starting there, just where can we actually go to get this data?
And we went on a rabbit hole on this, but do you work with banks that have data warehouses or have a common repository of data that those different departments share and can rely on? Typically, do you see that?
I mean, there are plenty of banks that have a single data warehouse. I would say it's more common that it's spread across different core systems.
Yeah. Oh, perfect. Now we've got a roadmap here. Obviously, Q4 2026, so that's end of the year. We want to make sure your default recovery is clean. We've talked how critical that is, making sure you have the ability to generate a clean LGD. But Q1 that's going to be really, really critical. Making sure you're starting to do your dry runs. Looking at not necessarily a formal model validation, but making sure you understand this model works, making sure your board and management understands all of your assumptions, because you're going to be getting potentially different allowance number. You want to make sure you can explain, you're going from an incurred model to an expected model. Why did my allowance change? What are my drivers? But kind of to walk me through some things banks need to think about as they're starting to develop their model over, the last half of the year or the last quarter of the year, first quarter of next year.
One of the thoughts I have in Q1, right? Once you arrive at Q1 of next year, you're at the point where you've done your roadmap, your data assessment, you've come up with that roadmap, you've done whatever remediation plans you have. You have clearly reached out and engaged stakeholders. You've understood, where the data is and the governance around it. In Q1, you're now tweaking it. You're running and tweaking the model. You're running past quarters. You're looking at it. You're doing parallel runs. You want to see, how does it look? How does it compare? Because there is a change. There is an important change, right? And because the way the accounting treatment is going to be when you implement the new ECL, right? Making sure that you have that first model run when you go into production to be as close, as accurate as can be, is going to be very important from an accounting standpoint, right? But in Q1, you're running multiple scenarios. You're running multiple runs, right? You're communicating, right, to your committees. You're also outlining and being very clear with your stakeholders. Who do you need to inform? But also, who do you need to get approval for? If it's an assumptions, if it's a change in assumptions. So you're writing out your policies, you're writing out your requirements, what committees have the authority to make certain changes, when certain changes will happen, when is the frequency of reviews of certain criteria, like the underwriting. In Q1, all of that has to be in place, and you have to run through a simulation. You cannot just talk about the model and the output. All of what we just talked about has to be in place. Q1 is a refining, fine-tuning, tweaking, dotting all the I's and crossing all the T's on your policies and procedures. That's the period you should be in. So that means that all that work you have to do is now in the remaining part of this year.
And one thing I'd add on top of that, we haven't really talked about documentation a lot. You should be documenting throughout this process. You shouldn't just wait, okay, now we got the model, now everything, let's go back and document. You should be documenting from day one what processes you're going through.
Great point, Brian. And Harvey touched on it. Policies and procedures are going to need to get built over the next few months, especially as you want to have your ECL policy written prior to go live. So that's going to take time to get approved and everything, but don't obviously ignore your procedures. Your procedures are going to get looked at as much as your policy sometimes, because they're going to want to see what your steps are, if you will. Now, let's go to the next page. I'm sorry, go ahead, Tarita, go ahead.
We talked about Q1, dry runs complete. So by this stage, we are running a couple of, dry runs. What if something goes wrong? We need to go back and change some loan information or any segmentation maybe. Can we do that and then come back to the dry run again? Is that possible?
Absolutely.
Yeah.
If you find, go ahead, Brian.
I was saying, yeah, I mean, that it's likely that you'll find that maybe we have to tweak our segmentation or something like that. And that's why, to Rob's point before, getting those procedures correct from the start is really important, because then we just follow our procedure back and we follow how we documented it, and that makes that whole process cleaner, faster, and more accurate.
And dry runs are iterative too. The model you develop at the beginning of Q1 is probably not the model you're going to have at the end of Q1. You're going to go through a bunch of different models to find the one that's best at your portfolio. A couple of things. We've talked about this a lot, how critical your data is. Your data is your model. Data comes first. The accuracy, credibility, and sustainability of your ECL model is ultimately going to be dependent upon the quality of the data that supports it. So we've got some core principle here, and this goes back to one of those first slides. Data readiness needs to be prioritized over model selection, over model provider, model selection, your whole PDLGD framework. Your data readiness is the linchpin that is the building block of your CECL model. Your calculations need to be based on that data to minimize subjectivity and make it more examiner, regulator, defensible, auditable, if you will, too, as well. Key takeaways: ECL, it's a data issue. It's not a modeling problem. If your data is not correct, you're going to have a modeling issue. Your ability to reconcile your data and have confidence in your data is going to determine how you calculate your PDLGD. Understand your gaps. Make sure, to Brian's point, you quantify everything, any changes that you've made, but also understand, your qualitative factors. First three things you need to think about, Harvey touched on it. Build a loan level historical data library of validated data. You want to strengthen default, charge-off, and recovery data capture, And then data governance needs to trump all. It needs to be enforced across all platforms, from loan administration through credit origination, all the way up through and including servicing. Now, for folks here, some of our experts here, what's one thing that a bank should walk away from with this webinar? We talked about, Harvey mentioned a couple of data points, but is there an overarching sort of a concept we need to, have folks walk away from here? Again, we're focusing on data. They're starting this process, but what should folks take away from this webinar, if you will?
Yeah, one thought that comes to mind, and this kind of goes back to leveraging the lessons learned with institutions who implemented IFRS 9 and CECL. The change from a backward-looking to a forward-looking ECL process was overwhelming, right? It's a significant change. It's dramatic, right? And what tends to happen, what we saw happen was this look at, and everyone here touched on it, this focus on the model. I need to understand the model. I need to figure out the model. Those things are important, but they're not more important and are not the first things you should think about. They're not more important than data, and they're not the first things you should think about. So what you should take away from this webinar is modeling is important, your platform is important, all of that, but that will come. You first need to really understand and assess where you are with your data, because that is going to guide you into the right path to pick out a model or a mitigation approach. It's going to help define your needs, and then you can work through the model. So the takeaway: start looking at your data. Don't forget about everything else. Just put it aside for a moment. Focus on your data. Identify your stakeholders. Where's your data coming from? Where is it going to come from? Where is it at? Understand who reconciles them. What's the governance? Just learn everything you can about the data, because as this title says, your data is the model.
And we're going to talk about this in future webinars, but your data is a strategic asset. We're going to allow you to let you use your ECL model strategically, not as a standalone accounting exercise, but being able to understand your data, being able to understand your data history is going to allow you to strategically look into the future to see how your portfolio can perform under a variety of different economic circumstances. So we're going to encourage you to use your ECL model, again, very, very strategically, but it all starts with your data. Making sure your data is correct on day one, because again, it's a very important asset for banks.
And the one thing I would add too is, this thing is coming, it's coming soon, but you don't need to panic if you haven't started yet.
Right.
As long as you start with the data and you focus on, getting a good governance and process starting today, you'll be fine.
And we've done this before. CECL, IFRS 9. Folks, if you've got any questions and just want to bump some ideas off of us, or just honestly, you could schedule a complimentary data readiness session with us. We're happy to kind of walk you through more of what we've discussed in more detail. We're happy to help you start your remediation process and get you ready for ECL. To Brian's point, it's coming up quickly, but you still have time. But we're here to help you in any way to get you started on your ECL journey. All right.
I think
And
with
Rob,
that,
Go ahead.
sorry. I was asking, this is webinar 1. We have touched on the data, the importance, and the gaps, and so on. What are we covering in webinar 2 at a very, very high level, if you can?
Yeah, so webinar 2 is going to take us through a full calculation. It's going to walk through all the different components and show you how data is going to be very, very critical. We're going to show you how your inputs and assumptions combined with your economic forecasts are going to calculate a reserve. Now, we're going to have our economic colleagues from Capital Economics show up here, and they're going to walk through, show you how their economic forecasts are going to factor into an ECL calculation.
But it's going to be, Rob, I believe it's going to be a journey, right? An end-to-end.
It's a journey.
Right?
It is a journey.
Calculation, yes, of the ECL from beginning to end. Not only the the modeling piece of it, but also the assumptions, how
Yep.
various inputs, right, play, qualitative factors, economic factors, and then the reporting and the
Yep.
analytics that you can get out of it.
And then our third webinar, to jump a little bit ahead, is kind of life both before ECL and after. We're going to talk about readiness and auditor expectation, examiner expectations, as well as, I mentioned it a few seconds ago, the strategic use of that ECL model. So there's a lot more to come, but guys, it starts with the data. Everything that we're going to talk about builds on the quality of your data. I want to thank our folks here on the line here. I thank my colleagues here, Srividya, Abuday, Brian, Rahul, and Harvey. Thank everybody for watching. Hey guys, if you have any questions, please let us know. We're here to help you.